Hi, I'm Corey Litzenberger with CGL Strategic Business and Tax Advisors. Welcome to another online edition of CGL's Tax Tips. You can find this in various methods, so you've probably found it through one of these ways, but you can also find it on our website at CGLtax.ca and click on the Video Tax Tips link. There are several of our other online videos on there. You can also find us at facebook.com/CGLtax. And please like our page so that we can keep you informed and updated of any more information that comes about. At twitter.com/CGLtax, you can follow us there, and also on YouTube at youtube.com/CGLtax. We want to talk a bit today about some common tax myths that are out there, and just give you some answers to the myths. I mean, we could talk about the myths I can go on forever on some of the stuff that's out there. There's 10 here that I've actually I've stolen or borrowed, whichever one I say, from a colleague of mine. Kim Moody is a chartered accountant and trust and estate practitioner who's been published many times in many of our reference materials as tax geeks, as I call myself. This gentleman is probably by far one of the brightest tax minds in Western Canada, and so if I don't know it, I guarantee you he does. Even if I think I know it, chances are he'll correct me. So Moody's Tax Advisors in Calgary, moodystax.com, I highly recommend them for stuff that we can't help you with. I'm sure he's going to give me heads for that one. One of the main ones here is obviously whether or not if tax is legal, whether or not the government can actually impose tax. And some myths that you hear out there go back to the Magna Carta and so on. And unfortunately, as much as I would love to have that as an out, we look for loopholes in income tax every day. Yes, the imposition of income tax in Canada is legal in Canada. And anyone who states otherwise is leading you down the wrong path. Another one that is common, and this is quite common, is saying, well, I've never been audited. I've always done it this way. CRA has approved it. Well, when they say CRA has approved it, that usually means because they got a notice of assessment, and they think that they've been reviewed or looked at, and that the CRA is fine with whatever they filed. All that means, all a notice of assessment means, is it starts the clock. So you file your return, and the clock starts before they can stop reassessing you. However, they can reassess you with no time, so unlimited time limit, if they can prove that you were doing things purposefully, so to avoid tax or willful neglect or gross negligence to that effect. So, the Canada Revenue Agency, or the CRA, has not accepted your filing positions just because you received a notice of assessment. They generally have 3 years, with some exceptions that can extend this time, from the date of the notice of assessment to review and make changes to your return. So just because you got the nice blue sheet or white printout in the mail, it does not mean that they accepted what you told them. Okay. Another one that's a good one is, well, can I pay my kids a salary, or I do pay my kids a salary, and I heard somewhere that $10,000 can be paid to my kids if I'm in business. And I find that laughable because, no, the CRA does not allow $10,000 of salaries to be paid to minor beneficiaries, or minor family members, I should say. The law does provide that reasonable salaries in the circumstances with a business purpose are deductible. So, for example, if your 2-year-old, or 4-year-old, or 6-year-old, or 8-year-old can't work at Walmart and make $10,000 a year, chances are you can't pay them that either. Okay. So, another great scheme. Tim Hortons is one of my biggest competitors. Tim Hortons Tax Planning. I'm sure you've heard of them. They're usually sitting there in a corner and debating it. You can't avoid tax by simply gifting property to the next generation. Some people say that, well, I'll just give it to my kids and then there'll be no tax on it. No, that's not correct. Giving things that may have a tax component to them, such as investments, real estate, and valuable assets, if there's a taxable component in there, you may avoid probate. Okay, you may avoid some probate issues that happen when you pass away, but you do not avoid capital gains taxes if there is an inherent gain in that asset. Okay, so we want to make sure that you are aware of that. There is the property is being deemed to have been disposed of at fair market value. Selling it to them for $1 does not get you out of this mess. In fact, it makes it worse. So please contact us if you have, or Kim, if you have those concerns. My comment is, don't get me started what happens on gifting if you're a U.S. citizen, because the U.S. Has a gifting tax. So it's even worse than what we have here. So the other one is charitable tax shelters, and we speak to this in a separate video earlier that we did in November, or actually the very first one that we did online, called the Tax Tip 01, in regards to beware of these donation type schemes. So they're saying, or tax shelters, someone is saying that if you buy a charitable tax shelter, you'll be able to save more in taxes than the actual cost of the investment that will be donated. Dream on. Those are Kim's words. If it's too good to be true, it likely is. The CRA has been successfully attacking charitable tax shelters for years. The CRA has written on this often, and we have discussed it in our November 2011 video. So you're looking at buying a vacation property, and someone told you that you can save a lot of tax if you purchase it through a corporation. There used to be some rules in regards to single-purpose corporations. Those no longer exist. Anytime a shareholder is getting any personal benefit from something that is owned by a corporation, we do have a taxable benefit issue. So the fact that a corporation owns a property elsewhere does not get away from the fact that somebody is using it and somebody may be benefiting from it personally, and therefore we have a tax problem. So get some advice on this. These types of plans of having a company buy a vacation property are usually ripe for disaster. So you're a U.S. citizen, or better yet, green card holder that's currently resident in Canada, and you're not compliant with your U.S. tax filings, and your response on that is, how will they find me? Or the U.S. has bigger fish to fry than me. Those are what you seem to use as your defenses. Well, they're about to be, those defenses are about to become very challenged. The United States is aggressively trying to find you. Their big brother is watching, as it were. I mean, they got drones going in Iran, supposedly. I don't know if we have any flying into Canada yet. But they're aggressively trying to find you, and there's a good chance they will, especially when the United States brings in what's called the Foreign Account Tax Compliance Act, or FATCA. I like to think that it's actually, they were going to call it the fat chance of them not finding you, but FATCA is the acronym they went with. So someone has told you don't pay Canadian tax on investment earnings from offshore bank accounts. Wrong, dead wrong. As a Canadian resident, you must pay income tax on worldwide income, regardless of where it's located. If you are resident in Canada, you have to pay tax on income earned in the Caymans, income earned in Switzerland, etc. And you may also have other reporting obligations, especially if they're valued or were purchased for greater than $100,000. So you think the disclosure of foreign assets does not include U.S. stocks, such like Microsoft, or Apple, Cisco. Citibank probably wasn't a good one there for a while, but it does. Okay, U.S. shares, U.S. stocks, foreign corporations, a foreign stock exchange, even if they're held by, say, RBC Dominion Securities, is still or considered. I better mention the other ones too: Scotia McLeod, TD Waterhouse, BMO Nesbitt Burns, and CIBC Wood Gundy. There. Now, hopefully nobody will be too upset with me. Those are the banks. There's a lot of private guys, and the guys over at Retire First, they do well too. All right, so I think I pleased all my investment advisor guys. ATB Financial, you're in there too. The definition of specified foreign property, okay, in the Act, specifically includes a share of capital stock of a non-resident corporation. Well, Microsoft is a non-resident corporation. Their shares that are traded are on the New York, or maybe they're the NASDAQ. I can't recall off the top of my head, but regardless, they are on a U.S. stock exchange. If you own shares in a U.S. company on a U.S. exchange, we do have to report a thing. And the reality is, it's just a reporting form. The penalty is quite steep if we don't report it, but it's just a tick box. Okay, nothing changes anything else. And lastly, this is a very common one, and I'm glad Kim brought this to my attention again. So you've lived in a house that you just built, or you've acquired it for one day, because someone told you that if you live in it for one day, it will be considered your principal residence, and then any gain on the sale will be tax-free. No, it doesn't work that way. The definition of principal residence in Section 54 of the Income Tax Act is very lengthy. It requires very detailed conditions to be met. One of the requirements is that the housing unit must be ordinarily inhabited in the year by the taxpayer's spouse or common law partner, or by a child of the taxpayer. I would argue, does one day occupancy meet the test of being ordinarily inhabited? Where else were you living during the year? We either got 364, or in this case 365 more days other than the one. So what other residences are we dealing with? Okay, you can only have one principal residence per year, and you affect all the others that way too. So each situation will need to be reviewed for the facts and the circumstances, but it would be highly unlikely that one day occupancy would meet the test of being ordinarily inhabited. For CGL Strategic Business and Tax Advisors, I'm Corey Litzenberger, thanking you for listening to this another updated online tax tips. Big thank you to Kim Moody of Moody's Tax Advisors in Calgary for letting me steal some of his content from his website. But these are definitely issues that everybody needs to be aware of. And again, if it sounds too good to be true, it probably is. I can't stress enough, you don't have to come see me only at tax time. You can see me throughout the year. You can get a hold of me, email, whatever, if you have a question as to what is going on. Do not wait until it's time to file your taxes, because by then, it's too late.